Welcome to the Inspired Podcast, everyone. We're kicking things off today with a deep dive that I think you're really going to enjoy. We're going to be exploring the world of successful investing, but we're doing it through the lens of one of the absolute legends in the field, Peter Lynch.
It's hard to think of a better guide, right? And we've pulled together some excellent resources for this deep dive to really get into the heart of his approach. So we're looking at excerpts from a YouTube video where Lynch himself lays out some of his core investment philosophies. And we've got a great book review and a super helpful executive summary of his landmark book, One Up on Wall Street. Oh, and of course, we've also got some interesting details about the book and the author from Goodreads.
That's a fantastic lineup. So our mission today is to take all of this fantastic material and really distill it down to the most valuable and actionable takeaways for you, our listeners. The goal is to understand how everyday observations, the things we see and experience all the time, and a focus on the actual businesses behind the stocks can lead to success as an investor. And importantly, we're going to do this without getting bogged down in all the complex jargon you often hear on Wall Street or trying to predict where the market's going next.
You know, it's fascinating. One of the things that really struck me going through all of these sources is how consistently they emphasize this core belief of Peter Lynch's, that the everyday investor, people like you listening right now, already have a huge advantage. He was a big believer in using your personal experiences as a source of investment opportunities.
It's a powerful idea, isn't it? This idea that the things you encounter every single day, the products you buy, the services you use, even just observations you make at your job can provide real early insights into potential investments. And that's really at the heart of One Up on Wall Street, which we'll dive into more deeply.
We've got some great examples to illustrate this too. Like there's this fantastic story about his wife and her love of legs pantyhose. She just loved them. And it got Lynch thinking, you know, if she loves them this much, there must be something to this product. And that simple observation gave him an early signal about the potential of Hanes, the company that makes them. And as we all know, it turned out to be a very wise investment.
Yeah, I love that example. It's so relatable. And it wasn't just consumer products either. Remember the La Quinta motels? Lynch himself noticed that they consistently offered a good product at a fair price. Clean rooms, decent locations, all for a reasonable cost. And that told him that they were a well-managed company with a strong offering.
Right. So what's so powerful about this invest in what you know philosophy is that it makes investing accessible to anyone. You don't need some fancy algorithm or to be a Wall Street insider. You can start with simply paying attention to the businesses and products you actually use and understand in your daily life.
Here's where it gets really interesting, though. Lynch was adamant that there's this strong link between a company's earnings its profits over several years and the long-term performance of its stock. Now, of course, those big macroeconomic factors, things like interest rates and inflation, they're important. But his point is that those are really hard to predict accurately, even for the so-called experts.
Exactly. So that raises this crucial question. Where should we as investors be focusing our time and energy? And Lynch had a very clear answer. Forget about trying to time the market or becoming an economic guru. Instead, really get to know and understand individual companies.
He was so good at capturing this idea in memorable quotes, too, like, "I own Dunkin' Donuts. You don't have to worry about Korean imports." That just sums it up perfectly. Focus on the strength of the company itself, the core of what it does, rather than trying to predict all the external factors that might influence the market.
The sources we're looking at also highlight how Lynch consistently urged investors to stick with industries they already understand. Leverage that existing knowledge. He felt that gave you a significant edge.
Yeah, there were some striking examples in the material about that, right? Like those people in the restaurant industry who missed out on investing in familiar companies like McDonald's or Cracker Barrel, all because they were chasing what they thought were hotter, more exciting opportunities in, say, biotech or oil. But those were industries they didn't really understand, and they ended up missing out on huge gains in the businesses they knew well.
Exactly. It's such a powerful reminder about focusing on where you have a natural advantage. And another really key point that comes up again and again is this. Lynch did not believe in treating the stock market like a casino. He was adamant about doing your research before putting your money into any company.
He makes this brilliant comparison, doesn't he, between how much research people do when they're buying something like a dishwasher and how little many people do before they buy a stock. It makes you think, right?
Absolutely. He really wanted investors to approach this with a thoughtful, informed mindset. And to emphasize this need for a clear understanding of a business, he introduced this concept called the 2-minute drill. Can you unpack that a bit?
Sure. So the 2-minute drill means being able to explain in simple terms what a company does. He said you should be able to explain it clearly enough that a 10-year-old could understand it. And you should be able to do it in, well, about 2 minutes. The point is, if you can't do that, you probably don't understand the business well enough to be investing in it.
It's such a fantastic and practical tool, isn't it? It forces you to boil it down to the essence. If you can't explain it simply, then it's probably too complex for you to truly grasp.
Right. Okay, let's shift gears a bit now and focus specifically on some of the key lessons that come out of One Up on Wall Street, particularly as they're highlighted in the book review, the executive summary we have.
So one thing that really stands out from the book review is just how relevant this book still is today. And remember, it was originally published back in 1989, but its core message, which centers on this value-oriented investing philosophy, looking at the long term and the underlying performance of the business, is just as powerful now as it was then.
And let's be honest, it's hard to argue with Lynch's track record. I mean, as a manager of the Fidelity Magellan Fund, he averaged an incredible 29% annual return, and he beat the S&P 500. That's a major market index in 11 out of the 13 years he ran the fund. Those results really back up his strategies.
For sure. One of the big principles he championed is this focus on the fundamentals of the business and how much it's actually worth, rather than getting distracted by trying to predict all these macroeconomic variables, interest rates, inflation. He believed that fundamentally strong companies will do well over the long term, regardless of those short-term ups and downs in the market.
This was a fascinating point to me. He actually favored what he called boring companies. Companies in industries that maybe weren't growing super fast but were solid and reliable. He preferred those over those hot stocks in industries that everyone's chasing after. I mean, that goes against what a lot of people think, right?
It does, but his logic is really compelling. He argued that these high-growth industries often attract tons of competition, which makes it tough for any single company to really achieve consistent profitability. In his view, the real key to long-term success isn't just industry growth, it's the actual earnings, the profits of the company itself.
He had a great analogy about investing in the companies that provide the tools and services to those high-growth industries, like the ones selling picks and shovels during a gold rush. Instead of trying to guess which gold mine will strike it rich, invest in the companies that benefit no matter who finds the gold. It's a clever way to think about it, right?
I love that analogy. Instead of betting on which specific tech startup is going to be the next Google or Amazon, maybe you look at the companies that provide the essential infrastructure or services to the entire tech sector.
Another key theme throughout all of this is the importance of knowing the story, really understanding the businesses you invest in. And Lynch actually broke companies down into different categories to help investors with this.
Yes. He had this framework for categorizing companies. Slow growers, stalwarts, fast growers, asset plays, cyclicals, and turnarounds. And understanding which category a company falls into can help you figure out what kind of returns to expect and which metrics to pay close attention to.
He was also very clear about when to consider selling a stock. His advice was, don't just sell winners too early, and don't hold on to losers without really evaluating if the underlying story of the company has changed.
Exactly. Your decisions about buying and selling should always be based on a careful analysis of the relationship between the stock price, the fundamentals of the business, and how much the company is really worth. You can't let emotions or arbitrary rules drive those decisions.
What's interesting is that Lynch actually saw price drops in fundamentally strong companies as potential buying opportunities. A chance to buy more of a good thing at a discount. That's tough for a lot of people because the natural instinct is to panic when the price goes down.
It takes a lot of conviction to go against that natural instinct. He cautioned against things like setting automatic stop-loss orders, which are designed to sell your stock if it falls below a certain price. He said you should only do that if you've determined that something fundamental about the business has changed, not just because the stock is temporarily down.
One of the things that really came through in the executive summary is this idea that anyone can become a successful stock picker. You don't need to be some kind of Wall Street genius. It's about doing your research, using logic, and paying attention to the world around you. In fact, Lynch's own story, he started out overhearing conversations about stocks while working as a golf caddy, proves that anyone can learn this stuff.
It's such an inspiring story. It shows that you don't need a fancy degree or connections to be successful. Common sense and a willingness to learn can go a long way.
The executive summary also talked about the historical performance of stocks compared to bonds. And as you know, over the long term, stocks have generally outperformed bonds. That's one of the reasons people take on the added risk of investing in equities.
Right, and that outperformance is ultimately driven by the growth of the underlying businesses. When the companies you invest in are expanding and becoming more profitable, that tends to be reflected in the value of their stock.
Before even diving into stocks, Lynch had some really practical advice for anyone looking to start investing. First, make sure you own a home and have a solid financial foundation. Then, think about whether you can actually afford to invest without putting your financial stability at risk. And, critically, assess whether you have those essential investor qualities, things like patience and the ability to think long term.
It's so important to have that strong foundation. He also consistently emphasized that trying to perfectly time the market, trying to guess exactly when to buy and sell to maximize your returns, is a fool's errand. Focus on finding good companies at reasonable prices and let the market take care of the rest over the long run.
And here's another reminder of that idea about everyday investors having an edge. We often have insights into companies whose stock prices are going up before those changes are widely recognized. We see it in our own lives, in the products and services we use, sometimes even in the industries we work in.
And remember, he believed that smaller, potentially undervalued companies could offer the biggest growth opportunities. You might not find those explosive returns in the giant companies that everyone already knows about.
That focus on boring companies really stood out to me. He argued that these companies, the ones with unexciting names and maybe less glamorous businesses, can actually be fantastic investments because they often fly under the radar of the big investors and analysts.
Absolutely. And he was very clear about avoiding those hot stocks in the hot industries. The intense competition in those areas can make it really hard for companies to maintain strong profitability over time.
Bottom line, it always comes back to earnings, according to Lynch. In the long run, the earnings of a company, its profits, are the most important driver of its stock price.
He really stressed the importance of that 2-minute drill as a way to keep yourself updated on the company and any major changes in its business. Can you quickly walk through some of those key metrics he said investors should focus on?
Sure. So he recommended paying attention to things like what percentage of a company's sales are coming from a particular product or service. Is it overly reliant on one thing? Then look at the price to earnings ratio, or PE ratio, relative to the company's growth rate. And of course, assess the company's overall cash position, how much money it has on hand. Those are all things you can easily find and understand, even without being a finance whiz.
And he also advised investors to regularly recheck the story of a company they own. Understand where it is in its growth cycle. Is it a startup? Is it rapidly expanding? Is it maturing? Those are all different stages with different investment implications.
He even laid out a helpful checklist of things to consider before investing, including looking at the PE ratio, the level of institutional ownership, the strength of the balance sheet, and of course the cash position.
And he was realistic about the fact that you'll probably experience some losses in the stock market, even if you do your research. But he suggested comparing your overall performance to a benchmark like the S&P 500, which is a broad index of the market. That can give you some perspective on how you're doing.
He had some thoughts on timing, too. He said that market downturns, when the overall market is down, can sometimes create opportunities to buy good companies at a discount. But at the same time, he warned against those common sayings about stocks, like it can't go any lower or it can't go any higher. Those kinds of pronouncements are almost always wrong.
Totally agree. The market doesn't work that way. And in general, he cautioned against using those more complex investment tools like options, futures, and short selling, especially for the average investor. His philosophy was really about keeping it simple. Understand the businesses you're buying.
Okay, so let's turn to some of the more practical advice that came out of all of this research. What were some of the key takeaways for putting Lynch's ideas into practice?
Well, one of his big pieces of advice was to simply open your eyes and look around you. What products do you love? What services do you use all the time? What companies stand out to you? Then ask yourself, are they publicly traded? Could they be undervalued? You might be sitting on some great investment ideas without even realizing it.
I love that. It's all about connecting the dots between your everyday life and the investment world. And again, he emphasizes that you don't need to be a financial expert to evaluate a company. Just look at those key metrics we discussed, the ones that tell you about the company's financial health and stability.
The Goodreads review we looked at really hammered home that core message from One Up on Wall Street. Everyday investors have a real edge. They have knowledge and insights that Wall Street often misses. It's about tapping into that advantage.
And of course, there's that exciting idea of finding 10-bagger stocks that increase in value tenfold. That's a reminder of the power of identifying promising companies early on, the ones with huge potential.
Lynch also gave some specific guidance for investing in different types of companies, such as those that are cyclical, those that are undergoing a turnaround, and those that are growing rapidly. Knowing those differences can help you set realistic expectations.
And this is a constant theme. Think long-term. Don't chase quick profits. Investing is about patiently letting good businesses grow and compound their value over time.
Now, one reviewer on Goodreads did point out that some of the specific company examples in the book might be a bit outdated now, which makes sense given when it was written, but they stress that the fundamental philosophy of understanding what you invest in is as relevant as ever.
Another reviewer on Goodreads appreciated how clearly Lynch laid out the different categories of stocks and what to expect from each of them. It provides a helpful framework for thinking about your portfolio.
Lynch also really focused on the emotional side of investing, which a lot of people overlook. He talked about the importance of being patient, being detached from the daily ups and downs of the market, and being persistent even when things get tough. Those qualities are just as critical as financial analysis.
He even described those common emotional stages that investors go through. First, concern, then complacency, then sometimes panic. He wanted us to be aware of those emotions so we can manage them effectively.
Wise advice. He also said not to beat yourself up over missed opportunities. There will always be winning stocks that you didn't buy. Just focus on your own process and try to make sound decisions.
And he gave some very specific recommendations about what to look at when analyzing a company. Its earnings, assets, cash flow, profit margins, that PE ratio in relation to its growth rate, and its level of debt. Those are all tangible factors you can assess.
He also believed that you don't need every stock pick to be a home run to be successful. He said that if you can get 6 out of 10 right, that can be enough to generate impressive returns.
You have this funny term, diversifications, which is what he called it when companies start branching out into businesses that are completely unrelated to their core expertise. It can be a red flag, suggesting that management doesn't have a clear focus.
Understanding what percentage of a company's sales comes from a key product is also really important. You want to know if they're overly reliant on one thing because that can be risky.
And he reiterated that general rule. A fairly priced company will often have a PE ratio that's roughly in line with its growth rate.
And a strong cash position is vital for a company. It gives them a buffer to deal with unexpected challenges and seize opportunities when they come up.
Even looking at something like a company's inventory levels can be insightful. If they have a lot of unsold products sitting around, that could be a warning sign.
And when we talk about growth, he clarified that it's not just about revenue going up, it's about earnings per share increasing. And that can happen through a variety of ways, like cutting costs, raising prices strategically, expanding into new markets, or even selling off parts of the business that aren't performing well.
He was a big advocate for staying invested in the market over the long term and being willing to adjust your portfolio based on how those underlying companies are performing. You're not just buying and forgetting. You're constantly evaluating and making strategic decisions.
Right. And a key part of long-term success is being able to buy more of a good stock when the price goes down rather than selling out of fear. You have to have conviction in your analysis.
He also advised against getting too caught up in macroeconomic events and predictions. Unless something has a clear and direct impact on a specific business you're following, it's probably best to just tune out the noise.
He did, however, see insider buying. When company executives and employees are buying their own stock is a good sign. It often suggests that the people who know the company best believe it's undervalued.
And share buybacks, where a company repurchases its own stock, can also be positive because it can increase earnings per share.
And finally, he cautioned against buying into the hype around the next big thing. Those hot stocks often don't live up to expectations. Look for those less glamorous but more solid companies instead.
Yeah, the ones with the boring names, the unexciting businesses, even the ones that make products some people might not like. Those can actually be great investments because they often face less competition and build strong, loyal customer bases.
Companies that are spun off from larger companies can also be interesting because they often get overlooked. And those with low institutional ownership, meaning the big investment firms aren't heavily invested, might be hidden gems.
Even companies in slow growth industries can be good investments if they have a strong competitive position. And companies that have carved out a niche market can be very attractive.
And let's not forget those companies whose products are essential and that people need to buy over and over again, like consumer staples. That recurring revenue can make for a really stable business.
So there you have it. Peter Lynch's wisdom offers a path to successful investing that's both incredibly powerful and surprisingly straightforward.
And if you want to explore these ideas in more depth with some great visual aids to help bring it all to life, be sure to check out our YouTube channel. We have a bunch of great content there that you'll find really helpful.
Definitely head over to our YouTube channel for a deeper dive into these concepts. We've got lots of visual examples and further discussion there.
We hope you enjoyed this deep dive into the principles of Peter Lynch. And as always, thanks so much for listening to the Inspired Podcast.
So as we wrap up today's deep dive, I think it's worth taking a moment to reflect on this core idea from Peter Lynch: the power of the individual investor. You don't need a fancy Wall Street background to be successful. Use your own knowledge, your own experiences, and your own common sense to make informed decisions.
The principles we've discussed today are all about moving away from speculation and toward a deep understanding of how businesses create value over the long term. It's a really empowering message, and it's one that we hope will inspire you on your own investment journey.
Absolutely. So as you go about your day, think about the things you encounter. What products do you love? What services do you find indispensable? What companies stand out to you as truly exceptional? Maybe those observations are the seeds of a fantastic investment idea that's worth thinking about.
Thanks for listening to the Inspired Podcast, everyone.
And don't forget to subscribe to our YouTube channel for more insights and helpful visuals. We'll see you there, and we'll be back soon with another exciting deep dive.
Until next time.
Thanks for listening to the Inspired Podcast.